Welcome to the latest edition of LUMA's Market Report. I'm Conor McKenna, partner at LUMA, and today we're going to talk about how I have frankly become a complete broken record. But before we get into that, remember to download the report at lumapartners.com or click the link below. This is where you'll find all of the data on the public markets, M&A, and private financing across ad tech, martech, and digital content. A ton of great data in there, so be sure to go to our site and download. So back to how I've become a broken record. Well, it feels like for the last 4 to 6 quarters, I'm on here talking about just one thing, uncertainty. And unfortunately, I'm back here again with the same news. We're still in an uncertain market. And unfortunately, that's just the fact of what it is to be in this potential soft landing realm. The challenge and frustration with this point in time is that we can find bright spots in the market, and yet there's this constant cloud of uncertainty about how long interest rates are going to be rising. Could inflation come back? Are we going to go into a recession? And so there's this constant cloud that is just hovering over everything and moves everything out slower and takes a longer time to really find where that bottom is. Thus the soft landing. We just can't feel where it is or if we've hit it yet. And so what that means is we're not able to just make quick pivots to something. Instead, we're really entering what's more of a longer term view of how this market's shaping up. It's why you've had companies like Iconic Growth or SaaStr talk about the era of efficient growth, right? It's not a quick fix, but really a full change of how companies are thinking about where they're heading into this uncertain ecosystem. And trust me, it's incredibly challenging from an M&A market where uncertainty is the biggest driver of slowness in deals, which is why we still are in decade lows from M&A volume across the entire globe. While we're in this market, what we've decided we want to focus on for today is we know that cloud is covering over everything, but where are the bright spots? And in the last quarter, there have been a couple of them. There's been companies that IPO'd, a number of M&A transactions, some new news around hiring, and some new forecasts showing pretty positive ad spending coming in the next quarter and the next year. So let's get into some of those specifics. First, you've got the IPO market. Now this completely shut down as of 2021, but in the last 3 weeks, we've had 3 technology companies, Arm, Instacart, and Klaviyo, all IPO, and all were quite successful. The companies, popped a little bit on their first day and mostly have maintained their IPO pricing, even as the broader market has traded down. But there's one stock in particular we want to focus on, and that's Klaviyo. Now, this company is the first MarTech company to go public since 2021, the first in our coverage universe. It is also the poster child for efficient growth. Now, if you're to look at Iconic's efficient growth report that they put out the other week, they look at 5 different things: the ARR growth, net retention, rule of 40, net magic number, and ARR per FTD. And if you're to line Klaviyo up against these 5 metrics, they are doing well across the board. They've got above market growth at 51%, net retention right in line at 119%, and this is particularly impressive given the fact that they are large SMB footprint. They're 75% rule of 40 versus the median of 45%, net magic number at 1 times, and ARR per FTE at 425. They are sort of hitting it on all cylinders and have done a great job transitioning their business from 21 and 22 when they were burning cash to really becoming a profitable, growing business into 23, which is part of the reason there's been such great reception. There's also been M&A this quarter. As we talked about last quarter, there are going to be companies that can find themselves in some solid footing and start to make more strategic moves and look towards consolidation in the future, even in this time frame. You had companies like DoubleVerify acquiring Scibids, making a big move into the optimization side of advertising. iSpot acquired 605, Content Square consolidated with Heap. You had NovaCap with private equity putting a significant check with a $600 million deal into Cadent. And you even had Salesforce, who just 6 months ago disbanded their global M&A team, doing their first deal since with AirKit AI. And that's not the only news coming from Salesforce. They also announced the other week that they're going to start hiring 3,300 new people. And that comes after January this year, where they actually were let go about 9,000 or 10% of their workforce. So clearly they're seeing more strength in their business and is a very strong signal of a bright spot in certain parts of this market. And then there's ad spend. For the last 12 to 18 months, ad spend has also been in this sort of fog state where it's very hard to predict where things are going to go because of this pending recession. It's made it incredibly hard for public companies tied to ad spend to do forecasting in any strong way. And you've seen some companies pull back on guidance, which is very hard in any public company. But we've actually seen some positive signals recently. Companies like Magna have come out with new forecasts showing that they expect 2023 ad spend to be up 5% globally with a lot of acceleration in Q4. That is strong in any year around advertising. And that's even before we get to 2024, which has both the Olympics and a presidential election. So things are looking fairly bright from that perspective. And we'll continue to be looking out as to how this is going to impact the ad tech and flow down into the marketing tech sector overall. That's it for us today. Continue to be on the lookout for where the bright spots sit in this ecosystem, and we'll be back next quarter to wrap up 2023, which is a year, as you guessed it, can only be described as uncertain. I'm Conor McKenna, signing off.